If you're self-employed, you know the feeling, right? You look at your business account, you see a pretty healthy profit, and then that little voice pops into your head and asks, okay, but how much of this is actually mine? Well, don't worry, because we're about to pull back the curtain on that entire process step by step.
So let's just dive right in. We're going to tackle one big question. How in the world does $155,000 in profit for a business owner turn into their final tax bill? It's a journey, for sure, with some interesting twists and turns, and we're going to explore every single one.
And to make this really hit home, we're going to follow the 2025 tax journey of a fictional home improvement contractor. Let's call him Mr. Kwame Nkrumah. His numbers are going to be our roadmap for this whole thing.
Okay, so here's our game plan. We're going to start with net profit, then get into the self-employment tax twist. After that, we'll zoom out to the bigger picture with the AGI, uncover a really nice deduction bonus, calculate the final tax bill, and then wrap it all up with the key takeaways you can use.
First up, net profit. You have to remember, this is the foundation. It's the starting block. Every single number we calculate from here on out flows directly from this one.
So the formula itself is pretty simple. Mr. Nkrumah brought in $410,000 in gross receipts. Awesome. But from that, we have to subtract all his business expenses. You know, things like materials, subcontractors, tools, the whole shebang. For him, that totals $255,000. And that leaves us with our anchor number, $155,000 in net profit. Seriously, burn this number into your brain because it's what's going to drive all the other calculations we do today.
All right, next up, we hit our first big curveball, the self-employment tax.
You know, this is really one of those things that shows you the true cost of being your own boss.
Just look at the difference here. When you're an employee, you pay 7.65% for Social Security and Medicare, and your employer pays the other half. But when you're self-employed, guess what? You are the employer. That means you're on the hook for both sides, a grand total of 15.3%.
Now, here's something that trips people up all the time. Self-employment tax is not your income tax. They're two totally separate things. Think of SE tax as your personal contribution to the big Social Security and Medicare pot.
But thankfully, you don't pay that 15.3% on your entire profit. The IRS gives you a little break. First, you take your profit and multiply it by 92.35% to get your taxable base. Then, you hit that number with a 15.3% rate. For Mr. Nkrumah, that comes out to $21,900.80 in SE tax.
But hey, it's not all bad news. There's a silver lining. Since you're paying that employer half, you also get to deduct it. So half of that SE tax, that's almost $11,000 is a deduction you get to take later on to lower your income. Super important.
Of course, your business is only one piece of the puzzle, right? Life happens. So now we need to zoom out and look at the adjusted gross income, or AGI. This is where other life events come into play, like the fact that Mr. Nkrumah recently got married.
So let's build this new picture. We start with his $155,000 profit. Then we add in his wife's W-2 wages and a little bit of interest income. But then we get to subtract some really great deductions, like his wife's IRA contribution, and, you guessed it, that half of the SE tax we just calculated. These are what they call above-the-line deductions, and they lower your income right off the top.
So, once you add up all the income and subtract those key deductions, you get the household's adjusted gross income. For the Nkrumahs, that's just over $201,000. This right here is our new key number for figuring out their income tax.
But wait, there's more. We are not done with deductions yet. And this next one is a biggie, the QBI deduction. This is a massive tax perk for owners of what are called pass-through businesses. Think sole proprietors, partnerships, S-corps, where the profit just passes through onto your personal tax return. Now, the qualified business income deduction, or QBI, can seem a little tricky, but man, is it powerful. The basic idea is to give you a deduction for up to 20% of your business income. But there are limits. The IRS makes you run two different calculations to figure out what you actually get. And the rule here is super simple. You're going to take the smaller of those two numbers. For the Nkrumahs, that's a huge deduction of over $28,000. That comes straight off their income before the tax is calculated. That is a game changer.
Okay, deep breath. We've added up all the income, we've taken all the deductions. Now it is time for the main event. Let's put it all together and calculate the final tax bill.
To figure this out, we have to look at the official tax brackets. And remember, the US has what's called a progressive system. This doesn't mean your entire income gets taxed at one flat rate. Nope. It's more like you're filling up buckets. Each bucket gets taxed at a different, higher rate.
So let's watch this happen for the Nkrumas. After all their deductions, their taxable income is about $140,000. So the first chunk of that gets taxed at 10%. The next big piece fills up the 12% bucket, and then the final amount spills into the 22% bucket. You add up the tax from each of those buckets, and you get their total income tax, $20,821.75.
But hold on, the tax you calculate isn't necessarily what you have to pay on tax day. It all comes down to withholding, how much tax you've already paid during the year. So in this scenario, let's imagine only $4,500 was withheld from Mrs. Nkruma's checks. That would mean they'd have to write a check to the IRS for over $16,000. Ouch. Now, let's flip the script. What if they had been really strategic and had $24,500 withheld during the year? The tax liability is exactly the same, but now, instead of writing a check, they're getting a refund of almost $3,700. It's the same income, the same tax, but a completely different result.
Okay, so after following the Nkrumas all the way from profit to their final tax payment, what are the biggest lessons here? What can we take away from their journey?
Okay, here are the big ones. First, it all starts with your net profit. Get that number right. Second, never forget that self-employment tax is a huge and totally separate cost of doing business. Third, major life events, like getting married, can completely reshape your tax picture. Fourth, always be on the lookout for those big deductions, like QBI. They save you a ton of money. And finally, and this is so important, your withholding strategy is what decides if you're writing a check or getting one back.
So that leaves me with one last question for you to think about. Now that you've seen this entire process laid out, from a simple profit number to that final tax bill, take an honest look at your own finances. Is your strategy setting you up for a nasty surprise bill or a nice welcome refund?
The scenarios in this explainer were put together using documents provided by Royale CPA Services. We really hope this has helped.